Renowned investor Ron Barron said in an interview that investing in Tesla long-term could easily make you extremely wealthy. With a 1% stake in Tesla Incorporated, Ron Barron predicted in 2016 that the company will rank among the most valuable companies in the world. At the time, one of the leading investors in electric automakers was his company, Barron Capital Management. A $4 billion profit was realized from the wager, but Barron thinks it's just the beginning, and that figure may increase over the following 10 years. What sort of investment approach does he employ? Why does he think so highly of the brand? Renowned investor Ron Barron has long been one of Tesla's top backers and has no intention of leaving. Barron recently stated to CNN that he intends to keep on to Tesla's soaring shares for at least the next 8 years, and that he thinks the company still has a lot more space to rise. If you're presumably new to Tesla stock and you're not familiar with Ron Barron, let us explain. He owns 1% of the Silicon Valley car, and his company, Barron Capital Management, was one of Elon Musk's major investors in 2016. According to Barron, we invested $380 million, or 1.5% of our total assets at the time, between 2014 and 2016. We already turned a profit of $4 billion, and I predict that in the next 10 years, we will make 3 or 4 times that amount. Barron gives his first rationale for investing in Elon Musk's electric car business. With Tesla, the possibility of changing American-made cars from gasoline to electric power was perceived as a reality. Tsla Capital, specializing in growth equity investment prospects, Barron's investment firm bears his name. It is a long-term equity investment organization. With Tesla's incredible rise over the past 3 years, it currently has around $6.2 billion, or 12.8% of its total assets, invested in the maker of electric vehicles. A total of $58.9 billion worth of assets are managed by Barron Capital. Tsla Capital, approximately $380 million were invested in Tesla by Barron's own company between 2014 and 2016. Barron reported making $54 billion in profits for his clients at an average price of somewhat more than $50 per share. Roughly $6 billion of those profits came from Tesla, in which he had invested $380 million 7 or 8 years prior. Additionally, he anticipates that SpaceX, another business founded by Elon Musk, would achieve a similar degree of success. According to him, the rocket company could revolutionize the $1 trillion satellite broadband market with the same qualities that made Tesla successful: a willingness to try new things in an industry that is set in its ways and a focus on cutting costs. This was discussed in an episode of Bloomberg Wealth with David Rubenstein. Barron noted that innovation is happening at the speed of light, and that this extends to autos and even space travel. In March of this year, Barron sold 1.8 million Tesla shares for his firm's clients in spite of the odds. He described the sale as regrettable but necessary for risk reduction. Though he believes he may still sell Tesla shares to lower his customers' risk, Barron says you have to be in it for the long run in order to actually profit from Tesla, and he doesn't look like he's ready to cash in just yet. According to Barron, holding is currently significantly more favorable than selling. Barron is correct when he says that investors should ignore short-term roadblocks like Tesla's most recent delivery error. The business has been doing all right, notwithstanding the performance of its shares. More volatility has been experienced by Tesla Incorporated than by any other stock in the history of the auto industry. Thanks to its equally controversial launch, it went from being a disruptive upstart to a social media favorite. Head of Musk Elon, no company has more reflected the purported speculative overvaluation of the market than the maker of electric vehicles, whose stock price just fell in the first quarter of 2022. Concerns about potential inflation, growing interest rates, and a European war have all added to the stock's continuous downturn. But Tesla shares weren't the only ones to follow this pattern. The overall market experienced a decline. But Barron isn't concerned about Tesla's stock price here. He said in the interview that the company expanded during a few years when the stock price was rather consistent. But thanks to its technology and software advancements, increased production and delivery, Tesla's self-driving infrastructure has so far resulted in a 5-fold increase in price per share at a time when index funds and exchange-traded funds, ETFs, are gradually surpassing stock pickers in market share. In hard times, Barron Capital's success as a traditional mutual fund provider is unusual. Barron has repeatedly stated that he has never faltered in his faith in the company. He declared that his company would purchase more Tesla stock if he had his way. Even though he personally owns more than 1 million Tesla shares, we think the company is doing great, and Barron's recommendation to concentrate on the business rather than the emotion of the market is a good one. Notwithstanding the challenges it has encountered thus far, a number of analysts think that given the company's recent product developments, Tesla is poised to achieve its objectives for 2022. Barron thinks that over the next 10 years, revenues might rise from $35 billion to $50 billion annually. This might lead to car sales of around $750 million. That does not even consider the fact that Tesla is manufacturing its own battery cells and plans to significantly expand those production in the upcoming years. Barron says that the battery industry is another amazing one that I'm very excited about. In the next 10 years, you'll see a five-fold gain with that kind of valuation. Regarding what precisely will propel Tesla's growth even further, analysts are divided. Tesla's success has been predicated on the idea that self-driving cars will revolutionize transportation, even if the company's autopilot and fully autonomous packages have shown some promise in recent years. Morgan Stanley analysts are dubious about the ability of autonomous driving initiatives to support the automaker's growth and development. Instead, the financial institution is placing its bets on Tesla's core business of manufacturing vehicles in addition to other competencies like supply chain management, material procurement, and infrastructure development. Despite CEO Elon Musk's assurances since 2018 that the automaker would conclude its journey into fully autonomous vehicles, it is no secret that Tesla's theft and robotaxi ambitions have failed. Every year that passes brings with it new challenges related to manufacturing or the availability of essential parts, further postponing the release of a feature-complete suite or the launch of the much-anticipated robotaxi fleet. This has raised doubts about whether the electric vehicle company, which has already shown that it is skilled at manufacturing, would be able to sustain its enormous rate of growth through one channel and not another. According to a recent letter to investors from Morgan Stanley's Adam Jonas and other analysts, Tesla's true path to additional growth and higher valuations is to concentrate on what it does best. Tesla has increased car deliveries for 9 consecutive quarters by concentrating on increasing manufacturing accuracy and efficiency over the past few years. Whether or not manufacturing is the primary driver of Tesla's growth, the company's manufacturing capabilities appear to be the most viable path for it to follow, even though the closure of its most productive facility in Shanghai may put that streak in jeopardy. One thing is certain. Celebrity investor Barron believes that waiting it out and making long-term investments is the best way to make $1 million from Tesla shares. This is the only way for Tesla to grow, regardless of competition. You risk losing a lot of money investing in Tesla stock since it is just too volatile to generate consistent short-term profits. Many analysts raise their target prices as a result of a number of events, including Tesla's recent earnings call performance above analyst forecasts and the launch of additional plants. The analysts argued that Tesla's competitive edge over original equipment manufacturers and its ability to turn a profit even in the face of supply chain disruptions and operating at reduced capacity made the update worthwhile. Undoubtedly, as the company expands and creates new goods, it will become even more significant as it surpasses its existing standing, because the manufacturing and distribution of electric vehicles are directly related to profit margins that are more likely to give you a fortune than temporary gains. How do you feel about Barron's plan of action? Post a comment below.